So one of the major, if not the most important aspect of award travel is credit card rewards. Now, something happened that might change your ability to get certain credit cards. Banks and lenders often base decisions whether or not to give you a credit card or a loan based on your credit score. Fico is the company that is responsible for the credit scoring methodology. They've announced a new methodology that will take into account certain things that are not being considered right now for credit scores. They're calling it the FICO 10 Suite. So let's take a look at the changes that are likely to change your score slightly or a lot, depending on whether or not either of these new factors affect you. The good news is that you probably have until the end of the year, if not maybe even a year and a half, to get your house in order before the changes go into effect. There are going to be two new changes. Number one is what they're calling trended data. It's basically a 24-month look back period to get a series of snapshots of your credit usage over time. Well, your entire credit profile over time. What they'll be able to do now is look back at a series of, I guess we'll call it like credit reports. So this new look back period or trended data will give lenders a much better idea of how you use your credit and how it fluctuates over time. The second change is the one that I think is going to hurt a lot of people. It puts a much heavier emphasis on personal loans, that's like refinancing, and it's actually a negative emphasis. So if you're the type of person who is constantly refinancing your mortgage or your high interest credit cards or whatever, that is going to be part of it, and it's going to be much more heavily scrutinized than it is before. Okay, so who is this going to affect and what should you do about it? First of all, it's definitely going to affect people who carry balances and those very smart people who take advantage of arbitrage opportunities. I'll give you an example. People who take advantage of no fee or low fee balance transfer offers. A lot of people in this space will do it because maybe they're investing in like cryptocurrencies or stocks, or basically the amount of money that they're borrowing at 0%, they're earning a much higher percentage on it. Essentially, they're leveraging their available credit to earn interest or take part in other opportunities, maybe like bank account bonuses. These people are probably not going to fare well under the new model because it's going to look at your personal loans in comparison to your credit card debt, right? So if you take out a personal loan and that goes up, but your credit card debt goes down, it's not necessarily going to be the same situation where now they just look at the amount of credit card debt. People who regularly carry a balance are probably also not going to fare well under this new credit scoring methodology because they're able to see what your balances are over the last 24 months. And a person who does not pay off their balance in full every month is a much higher credit risk than somebody who does. A few ways that you might want to combat this might be to stop using balance transfer offers unless you're maybe not going to be applying for new credit right now. And you might want to occasionally prepay a bill. So let's say you have a huge purchase and you're planning on paying it off at the end of the month. Let's say it's like $5,000 and your available credit is $100, right? You don't want them to look back at that one time period and say, well, this person has times where they fluctuate in their credit utilization ratio, right? So maybe if you make a big purchase, maybe just like prepay it if you have the money, because I think that's probably going to be an easy way for people to keep things steady when it comes to their credit scores. Number two, obviously, don't make late payments. They stay on your account forever and they're terrible. If you forget, which happened to me more times than I'm willing to say. If it's a lender that you've had like a long relationship with, they're much more likely to work with you to remove the late payment from your history. But again, if they're looking at trended data, that won't disappear because it showed up on one of the reports, right? It's really important to note that the credit score is going to be, the FICO 10 suite is going to be available to lenders by the end of the year, most likely. But it's completely up to them whether they want to adopt the new framework or stick with the old one. The scores are still from 300 to 850. And again, it's completely up to them. They can consider it or not. So I guess only time will tell whether or not this will actually affect you. But if you're somebody who maybe does have like a big student loan or who has temporary cash flow issues from time to time, you might want to start getting your cards now. I mean, I hate to tell people to like sign up for a bunch of cards and do like an Apple-rama, but it's something to consider because, you know, maybe your scores tank in a year or so, and then, you know, it's difficult for you to continue doing what you're doing and still earning new credit. So something to think about, and definitely keep an eye on the way that things are changing, because what one bank does is is usually a good predictor of what others will do. You know, like when Chase started 524, other banks started to restrict their application approvals as well. So it's just like common sense. You'll be okay as long as you are creditworthy and you pay attention. I would love to know other ways that you guys feel like you might be affected by the new scoring and what your predictions are as to whether the banks will actually adopt any of it. Because, fun fact, FICO 9 is barely ever used, but FICO 8 is the one we use. Also, if you're using Experian Boost, I think it is, that's basically like monthly bills that are not necessarily reflected on your credit report can be reported to Experian. And then, I hope I said that right. I said it two different ways, so one of them has to be right. Can be reported to Experian, and Experian considers that when reflecting your score to banks. So you will be able to keep raising your score that way. It won't affect that. Credit card companies will definitely have a more reliable predictor of your overall creditworthiness as a customer based on the trending data. One thing that I don't know that I am definitely going to look into is whether that counts for student loans. Because currently, your student loan balance is not what is reflected on your credit report as an outstanding debt. Instead, it's the amount that you currently owe. So I know somebody who has like $700,000 in student loan debt. And because they're in an income-based repayment program, the amount that is outstanding as a loan is only what is due each month. I don't know how the new changes are going to affect student loan borrowers. So that's definitely a big thing to keep an eye out for, and I will let you guys know as soon as I find out. And then while this is not an official change, it seems that late payments are going to be much more negatively emphasized, right? So if you have a late payment or whatever in the last couple of years, that's going to count for a bigger amount than it does now. The new FICO suite will still rely on the standard factors, which are payment history, average age of credit. That is basically how long each of your accounts has been open, and it's an average. Your credit utilization ratio, that's the proportion of outstanding credit card debt to what you have available. So if you have like 10 cards and they all have a $10,000 credit limit, you have $100,000 in available credit. If you're only using $2,000 on one card, your credit utilization ratio is 2%. And that's sort of like one of those counterintuitive things that people are always confused by. So like if you get more cards and get more credit, that actually is helpful for your credit score because you're using less of your cushion. Cushion being the difference between your outstanding debt and your available credit. Then you have credit mix and new credit accounts. That's basically how many you have open and in what period of time. As we all know, 524 is based on that. So we're very familiar. So just to recap, the new model will treat debt and late payments much more severely, and will also include a much longer, much more complete picture that goes back 24 months called trending data.